Disclaimer.
Hello, everyone, on this first day of 2026. May this year bring you joy, prosperity, and good health. Today, I'd like to talk about a topic that may surprise you. December 8th, 2025. While American investors obsessed over whether the Fed would cut rates by a quarter point or hold steady, something far more consequential happened halfway around the world. The BRICS nations launched a pilot program for their new currency unit backed by 40% gold and 60% member currencies. You probably didn't see it trending on social media. Financial news barely mentioned it. But make no mistake, this was the opening move in the most sophisticated financial chess game our generation will witness. Here's what should grab our attention. This wasn't some theoretical announcement or diplomatic posturing. According to the Bank for International Settlements, the infrastructure for this system has been quietly operational for months through something called mBridge. Real banks, real transactions, real alternatives to the dollar-dominated payment rails that have controlled global trade since 1944. Think about your retirement account for a moment. What if I told you that the mathematical foundation supporting the value of those dollars has fundamentally shifted, and most Americans have no idea it's happening? We're not talking about a market correction or a recession. We're talking about a structural change in how the world's reserve currency operates. But here's where the story gets really interesting. The Checkmate move wasn't December 2025. That was just when it became visible to anyone paying attention. The real turning point happened 20 months earlier, and the data is absolutely stunning. March 2024. The People's Bank of China released routine payment statistics that financial analysts initially dismissed as noise in the data. Chinese yuan transactions crossed the 50% threshold in China as cross-border payments for the first time in modern history. The renminbi hit 52.9%, while the US dollar fell to 42.8%. Pop quiz: when was the last time the dominant global reserve currency lost majority share in the world's second largest economy? Never. Because it's never happened before. You're probably thinking this is just China doing business with China, right? Chinese companies paying other Chinese companies in yuan makes perfect sense, but that's not what the data shows. According to SWIFT financial messaging data, this shift includes international transactions flowing through Chinese banks, foreign companies, foreign currencies, foreign trade, all increasingly bypassing the dollar. Now let me put this in perspective with a scenario you can actually visualize. Imagine you're a Brazilian mining company selling iron ore to a Vietnamese steel manufacturer. 20 years ago, you'd invoice in dollars, receive payment in dollars, and convert to your local currencies, paying currency exchange fees twice and accepting dollar exchange rate risk throughout the transaction. Today, that same transaction increasingly happens in yuan through Chinese banking infrastructure. No dollars involved. No US bank intermediaries taking a cut. No exposure to Federal Reserve policy decisions. The implications ripple through every corner of global finance. When oil trades in dollars, when commodities price in dollars, when central banks hold reserves in dollars, all of that creates constant demand for our currency. It's what economists call the exorbitant privilege. We get to print the money the whole world needs, which means we can run deficits other countries could never sustain. But what happens when that demand starts eroding at the margins? Now here's where our economic reality gets genuinely uncomfortable, and we need to talk about it honestly as Americans who care about our country's future. We're trapped in what I call the triple war paradox, and the mathematics are absolutely brutal. War. Number one, the artificial intelligence arms race. We're not just competing with China. We're in an existential technological sprint that will define economic and military dominance for the next 50 years. TSMC's Arizona fabrication plants, domestic chip manufacturing, quantum computing research, AI model development, these aren't optional investments. They're survival requirements. The price tag runs into hundreds of billions annually. War number two, supply chain reconstruction. COVID revealed that our entire economic security depends on production capacity controlled by potential adversaries. Reshoring pharmaceutical manufacturing, semiconductor production, rare earth processing, battery technology. Every CEO and Pentagon strategist agrees we must rebuild domestic industrial capacity. But rebuilding what took 40 years to offshore doesn't happen cheaply or quickly. War number three, and this is where the mathematics become impossible. We're fighting both those wars while simultaneously servicing $37.6 trillion in national debt that generates $971 billion in annual interest payments. Think about that number. Nearly $1 trillion every single year just on interest, before we spend a dime on defense, healthcare, infrastructure, or anything else. Here's the paradox that keeps Treasury officials up at night. To fund the AI war and supply chain reconstruction, we need to issue more debt. But more debt means higher interest payments. Higher interest payments mean we need to issue even more debt to cover those payments. According to Congressional Budget Office projections, we are locked in a spiral where the interest on our debt will soon exceed our entire defense budget. You've probably heard politicians promise we'll just grow our way out of this debt problem. The economy will expand, tax revenues will increase, and everything balances out eventually. But let me show you why that comfortable narrative doesn't survive mathematical scrutiny anymore. To grow our way out of debt while simultaneously funding 2 technological and industrial wars, we'd need sustained GDP growth rates we haven't achieved since the pre-2008 era. And we'd need them while our working age population growth is slowing and our productivity gains are increasingly captured by AI systems that don't pay income taxes. The Federal Reserve faces an impossible choice, and every option leads to the same destination. Keep interest rates high to fight inflation, and the government's debt service costs explode while economic growth stalls. Cut interest rates to stimulate growth, and you risk reigniting inflation while making US Treasuries less attractive to foreign buyers. Either path leads to one conclusion: currency debasement, printing money to paper over the mathematical impossibility of the situation. And here's what Americans need to understand about their personal finances. When the government faces this kind of fiscal trap, your dollars in the bank, your bonds, your fixed income retirement accounts, they all represent claims on a currency that must mathematically decline in purchasing power. Not because of some conspiracy or policy mistake, but because the numbers simply don't work anymore. This is why December 8th, 2025 matters so much more than the market realized. China and the BRICS nations aren't attacking the dollar out of ideology or geopolitical spite. They're responding rationally to mathematical reality. If you knew the world's reserve currency faced an impossible fiscal equation, wouldn't you build alternatives? Wouldn't you accumulate hard assets like gold? Wouldn't you create payment systems that don't depend on a currency that must eventually devalue? The checkmate isn't that they're building alternatives to the dollar system. The checkmate is that our own fiscal mathematics make those alternatives increasingly necessary for any rational actor in global finance. We've checkmated ourselves, and the BRICS nations are simply responding to the position on the board. What happened in March 2024 with yuan payment dominance wasn't the beginning of this story. What launched in December 2025 with the gold-backed unit isn't the end. These are visible markers of a transition that has been mathematically inevitable since we committed to fighting 3 wars simultaneously with a currency that can only devalue to fund them all. The real question isn't whether this transition happens. The mathematics guarantee it does. The real question is what happens to American families, American retirees, American savers when the transition accelerates. And that's where the evidence gets even more startling. Let me show you something that should fundamentally change how you think about global finance. From November 2024 through December 2025, the People's Bank of China officially reported adding 44 tons of gold to their reserves. Financial media covered it with the usual analysis about diversification and hedging. But here's what those reports missed, and this is where the real story gets fascinating. According to data from the World Gold Council and independent analysts tracking physical gold flows, shipping manifests, and refinery outputs, China's actual gold accumulation tells a radically different story. The official reported reserves sit at 2,280 tons. But when you track the math, analyzing refined gold production that disappears into Chinese vaults, physical imports through Hong Kong that don't appear in official statistics, domestic mining output that never reaches international markets, the estimated actual holdings reach approximately 5,065 tons. Think about what that means. We're not talking about a rounding error or measurement discrepancy. We're talking about more than double the official reported number. Why would China systematically underreport gold reserves for years? Because they learned from watching what happened when other nations signaled their intentions too early. Here's a scenario that illustrates the strategy perfectly. Imagine you're planning to launch a new currency system partially backed by gold. If you announce you're accumulating massive gold reserves, what happens to the gold price? It skyrockets. Every ounce you buy after that announcement costs exponentially more. But if you quietly accumulate while officially reporting modest purchases, you can position yourself for a monetary transition while other central banks are still debating whether gold even matters in modern finance. The 13-month buying streak that financial analysts noticed represents just the tip of a strategic accumulation that's been running for over a decade. China produces roughly 370 tons of gold annually from domestic mines, making them the world's largest producer. And according to refinery data, virtually none of that production ever leaves the country. It goes straight into vaults controlled by the People's Bank of China or state-affiliated institutions. Now let's connect this to your personal financial situation, because this isn't just some abstract geopolitical chess move. When China accumulates thousands of tons of gold while launching currency alternatives to the dollar, they're building what financial strategists call an anchor asset for the post-dollar international monetary system. Gold doesn't generate yield, doesn't produce cash flow, And central bankers spent decades calling it a barbarous relic. So why accumulate it now unless you're preparing for a specific scenario? The answer becomes crystal clear when you look at the second piece of evidence. And this one's hiding in plain sight in official US Treasury data. Foreign ownership of US Treasury securities has collapsed from 50% in 2014 to just 30% in 2025. Let that sink in. The institutions that built the dollar's dominance as the global reserve currency, foreign central banks, sovereign wealth funds, international institutions, have dumped over $1 trillion in US government debt. According to Treasury International Capital data released monthly, this isn't a temporary adjustment or market timing decision. This is a structural shift happening methodically across dozens of countries simultaneously. China's Treasury holdings peaked at over $1.3 trillion in 2013. Today, they sit around $795 billion. Japan, our largest foreign creditor, has reduced holdings from $1.3 trillion to under $1.1 trillion. Saudi Arabia, Belgium, Ireland, almost every major holder has been systematically reducing exposure. You're probably thinking this sounds like bad news, but not catastrophic, right? Other buyers will step in, interest rates will adjust, markets will clear. But here's what makes this different from normal capital flows. When foreign central banks sell treasuries, who's buying? The Federal Reserve through quantitative easing, and domestic buyers forced to absorb supply at lower prices or higher yields. We're essentially printing money to buy our own debt that foreign nations no longer want. Let me paint you a picture of what this looks like in the real economy. Your neighbor works hard, saves diligently, and puts money into a bond fund for retirement because bonds are supposed to be safe. That fund holds US Treasuries, yielding maybe 4 or 5% annually. Sounds reasonable until you realize that foreign central banks are deliberately exiting those same positions, while our own government prints currency to absorb the supply. Your neighbor's retirement security depends on a market where natural buyers are disappearing, and the primary bid comes from monetary creation. This brings us to the third piece of evidence, and this one is the most concrete proof that the alternative system is not theoretical anymore. It's already operational. The Converging payment system launched by central banks from China, Thailand, the United Arab Emirates, and Hong Kong has connected 1,467 financial institutions across 111 countries. Not planned to connect, not in pilot phase. Already connected and processing real transactions. According to the Bank for International Settlements, which helped develop the technical infrastructure, Converging facilitates instant cross-border payments using central bank digital currencies without correspondent banking relationships or dollar conversion. A company in Dubai can pay a supplier in Shanghai directly, instantly, with full settlement, without touching the dollar or the SWIFT messaging system that's routed international payments through U.S. banks for decades. Think about the implications for American financial dominance. For 70 years, our greatest geopolitical leverage wasn't aircraft carriers or nuclear weapons. It was the fact that nearly every significant international transaction had to flow through our banking system. We could freeze accounts, block payments, enforce sanctions, and monitor financial flows because everyone needed access to dollar clearing. The Treasury Department could essentially cut any nation or institution out of global commerce by denying access to U.S. banks. That leverage evaporates the moment viable alternatives exist, and they don't just exist theoretically anymore. According to data from the participating central banks, Converging processed over $12 billion in transactions during its pilot phase. Real money, real trades, real proof that the infrastructure works. Here's where it gets even more interesting for anyone watching global power dynamics. The system uses distributed ledger technology, essentially blockchain architecture, that doesn't require a central authority or single point of control. No American veto power, no European regulatory oversight, no ability to freeze or sanction without unanimous agreement from participating nations. It's financial infrastructure designed specifically to neutralize the weaponization of the dollar that we've deployed increasingly aggressively over the past 2 decades. Let's connect these 3 pieces of evidence into a coherent picture. China accumulates thousands of tons of gold while underreporting official reserves. Foreign central banks systematically dump over $1 trillion in US Treasuries, despite those bonds being called the safest asset on Earth. And a parallel payment infrastructure goes live, connecting over 1,400 financial institutions across more than 100 countries. These aren't 3 separate trends happening coincidentally. According to analysis from the Atlantic Council's Geoeconomic Center, this represents coordinated preparation for a multipolar currency system where the dollar loses its monopoly position. Not eliminated entirely, our economy is too large and too sophisticated for that, but relegated to being one option among several rather than the only option that matters. You've probably noticed something unusual about inflation over the past few years. Official numbers say it's moderating, but your grocery bills, insurance premiums, and housing costs tell a different story. Part of that disconnect comes from how inflation is measured, but part comes from something more structural. When foreign central banks bought our treasuries, they essentially lent us money at low interest rates to buy their exports. That arrangement kept U.S. consumer prices lower than they otherwise would have been. As that dynamic reverses, as foreign central banks dump treasuries and build alternatives, we lose the deflationary subsidy that has masked the true cost of our consumption patterns for decades. The inflation you're experiencing in daily life reflects the real cost of goods and services without foreign central banks subsidizing American consumption through treasury purchases. Now, imagine this trend accelerating. More nations join Ambridge. More central banks diversify away from dollars into gold and other reserve assets. More international trade bypasses dollar settlement. Each incremental shift seems small in isolation, but they compound into something that fundamentally transforms how our economy operates. The evidence isn't hidden or classified. It's sitting in official central bank reports, treasury data, and Bank for International Settlements publications. But it's scattered across different institutions, different data series, different quarterly reports. When you assemble the pieces into a single coherent picture, what emerges is undeniable proof that the dollar, his privileged position, is being systematically dismantled. Not through military confrontation or political rhetoric, but through patient infrastructure building and methodical reserve diversification. This is why the gold accumulation matters so much. China isn't buying gold because they think it's going to double next quarter. They're positioning gold as the neutral anchor asset for a new monetary architecture, where no single nation's currency dominates. When you own 5,000 plus tons of gold and you're launching currency alternatives backed partially by precious metals, you're not speculating, you're architecting the next phase of global finance. And the timeline? That's what we need to examine next, because the mathematical certainties and specific targets make this more than theory. They make it inevitable. Let's talk about the year 2029, because that's when the mathematics become terminal. According to Congressional Budget Office projections, U.S. debt to GDP will hit 106% that year, surpassing the World War II peak of 105.4% that we reached in 1946. But here's the critical difference that changes everything about what that number means. When we hit peak debt to GDP after World War II, we were the only major industrial economy with intact manufacturing capacity. Europe was rebuilding from rubble. Japan's economy was shattered. We had demographic tailwinds with the baby boom generation entering the workforce. Global trade depended entirely on dollar settlement because no alternatives existed. We grew our way out of that debt with 25 years of sustained economic expansion. None of those conditions exist today. Our manufacturing capacity has been offshored for 4 decades. We face demographic headwinds with baby boomers retiring en masse. We're not the only industrial power. We are competing with China's manufacturing sophistication and Europe's technological capabilities. And as we've seen, alternatives to dollar settlement are already operational and expanding. The mathematics create an impossible choice that arrives with precision in 2029. According to Treasury Department debt service projections, by that year, we'll be spending over $1.4 trillion annually just on interest payments, more than we spend on defense, Medicare, or Social Security individually. Think about that scenario playing out in real time. Every single dollar of your federal income taxes goes to interest on past borrowing before we fund a single current program. When debt service consumes that much of the federal budget, you're left with exactly 2 options. Option 1, default on the debt, either explicitly by not paying or implicitly by inflating away the real value of what you owe. Option 2, cut spending so dramatically that you trigger a depression-level economic contraction. There is no option 3 where everyone wins and the economy grows smoothly. Here's where your personal financial planning needs to account for mathematical reality rather than hopeful projections. The federal government will not choose option 2. No democracy has ever voluntarily imposed depression-level austerity when the alternative of currency debasement exists. Politicians facing re-election will always choose printing money over telling voters their Social Security gets cut by 40%. That means option 1 is mathematically certain. Not might happen. Not could happen if policy mistakes are made. Will happen because the numbers permit no other outcome. The only question is whether it happens through gradual inflation that erodes purchasing power over years, or through a currency crisis that happens in months. Now, let's talk about gold, because this is where specific price targets emerge from the mathematical necessity we've been discussing. Central banks globally purchased over 1,000 tons of gold in 2022, over 1,000 tons in 2023, and according to World Gold Council data, they are on pace for over 1,000 tons again in 2024 and 2025. This represents the strongest sustained central bank buying in modern history. Not since the 1950s have we seen 4 consecutive years of 1,000-ton plus purchases. When central banks buy gold at this pace while simultaneously reducing treasury holdings, they're making a mathematical statement about where they see relative value. They're trading yield-bearing assets denominated in dollars for non-yielding physical metal. The only rational explanation is that they expect the purchasing power decline of the dollar to exceed the yield they're giving up. Let me give you a concrete scenario based on supply and demand fundamentals. Global gold mining production runs around 3,500 tons annually and has been relatively flat for years. New discoveries are rare, and developing mines takes a decade or more. Central bank demand alone is consuming nearly 30% of annual production. Add in jewelry demand from India and China, industrial uses in electronics, and investment demand from individuals and institutions, and you're looking at structural supply deficit. According to precious metals analysts and futures market positioning data, gold reaches $4,000 to $4,500 per ounce by mid-2026 as this dynamic plays out. That's not speculation or hope. It is basic supply and demand when central banks maintaining 1,000-ton annual buying pace meet constrained physical supply. The price must rise until either buyers reduce demand or miners dramatically increase supply, and neither is happening fast enough to prevent the adjustment. Think about what $4,500 gold means in your portfolio. If you own zero gold exposure, you are betting that central banks are wrong about the dollar's trajectory and that the fiscal mathematics somehow resolve favorably. If you own some gold allocation, you're acknowledging the mathematical reality while maintaining exposure to dollar-denominated assets. The question isn't whether gold goes higher. The supply-demand imbalance and central bank behavior guarantee it does. The question is whether your personal allocation reflects the structural shift underway. Now here's where the timeline becomes critically important, because three major transitions converge between 2027 and 2030 to create what I call the one-way door for dollar reserve status. Once we pass through this convergence, there's no going back to dollar monopoly. First, the BRICS gold-backed unit expands through 2027 according to the announced implementation schedule. What launched as a pilot in December 2025 scales to full operational deployment, connecting all BRICS member nations plus dozens of partner countries. According to statements from participating central banks, this isn't exploratory anymore. This is infrastructure going live for international settlement. Second, BRICS Pay becomes fully operational by 2030. This is the consumer-facing layer that makes alternative currency settlement accessible to regular businesses and individuals, not just central banks and major corporations. Imagine being a small exporter in Brazil or a manufacturer in South Africa using your phone to receive payment in gold-backed units from a customer in Russia or India, settling instantly without touching dollars or paying Western bank fees. Third, and this is the convergence that makes everything irreversible, the 2028 US presidential election coincides precisely with peak debt refinancing crisis. According to Treasury borrowing schedules, we have over $7 trillion in government debt maturing between 2027 and 2029 that must be refinanced. The incoming president in January 2029 inherits the impossible choice we discussed: default, inflate, or cut contract. Think about the political dynamics of that moment. Whoever wins the 2028 election faces day one decisions about whether to print trillions to refinance maturing debt, whether to cut spending enough to avoid monetary expansion, or whether to try threading an impossible needle between those options. Meanwhile, the BRICS currency infrastructure hits full operational capacity at exactly that moment. The alternatives to dollar dependence become fully functional, just as America's fiscal credibility faces its greatest test. Foreign central banks and international businesses watching this convergence face a simple calculation. Do you hold assets denominated in a currency whose issuing government must choose between default and debasement? Or do you shift toward alternatives backed by physical gold and managed by countries running trade surpluses? When you phrase the question that way, the answer becomes obvious. This is why I call it a one-way door. Once major trading nations and financial institutions shift payment infrastructure, reserve holdings, and settlement preferences toward alternatives, the network effects that created dollar dominance begin working in reverse. Every business that adopts BRICS Pay reduces demand for dollar clearing. Every central bank that shifts reserves from treasuries to gold reduces the treasury market's depth. Every trade settled in yuan or gold-backed units is one less transaction, creating dollar demand. You've probably noticed I haven't mentioned some dramatic collapse or panic scenario. That's intentional, because the most likely outcome isn't a sudden crisis. It's a grinding, inevitable transition that happens slowly at first, then all at once. The dollar doesn't disappear. It becomes one currency among several rather than the mandatory default for international trade. But here's what that transition means for everyday Americans, and this is where we need to be honest about the implications. When the dollar loses reserve currency premium, the inflation subsidy we've enjoyed for decades disappears. Imports cost more because foreign producers no longer need to accept dollars to participate in global trade. Interest rates stay higher because foreign central banks aren't buying our debt to suppress yields. The government's ability to run deficits shrinks because we can't just print the global reserve currency anymore. For your retirement planning, This means fixed income portfolios face sustained purchasing power erosion. For your career planning, it means industries dependent on cheap imports and low interest rates face structural headwinds. For your investment strategy, it means the assets that performed well in a dollar-dominant world may not be the assets that preserve wealth through the transition. So what's the action plan for someone who understands this timeline? First, recognize that you can't stop the mathematical inevitability, but you can position yourself appropriately. Physical gold and precious metals represent insurance against currency debasement that central banks are literally telling you they're pursuing through their buying behavior. Second, understand that the 2027 to 2030 window is when alternatives become fully functional while our fiscal mathematics become terminal. That's not decades away. That's inside a standard retirement planning horizon. Whatever allocation adjustments you make to reflect this new reality need to happen before the one-way door closes, not after. Third, remember that this is not about pessimism or fear. It's about adapting to changing financial architecture the same way you'd adapt to any other structural shift. Americans who recognized the internet's importance in 1995 positioned themselves for the digital economy. Americans who recognize the multipolar currency transition in 2025 can position themselves for what comes next. The checkmate that China executed wasn't through military confrontation or diplomatic pressure. It was through patient infrastructure building, strategic gold accumulation, and mathematical inevitability. While we were focused on quarterly Fed meetings and monthly inflation prints, they were constructing an alternative financial architecture designed for the moment when our fiscal mathematics force the choice between default and debasement. That moment arrives with mathematical precision in 2029. The infrastructure becomes fully operational by 2030. The one-way door closes during the 2027 to 2030 convergence, and the gold price reflects the physical anchor replacing paper promises. December 8th, 2025 wasn't when this started. It was just when it became visible. The checkmate was already on the board. The mathematics guarantee the outcome. The only question is whether everyday Americans recognize what's happening in time to position themselves accordingly. The evidence sits in official reports, public data, and announced timelines. The mathematics permit only one outcome. The alternatives are already operational, and the clock is running on the transition that permanently fragments the dollar's reserve monopoly. This is the financial reality we need to understand as Americans. Not to panic, not to despair, but to adapt intelligently to the structural shift that mathematics, evidence, and timeline make absolutely inevitable. Thank you for watching until the end. To make sure you don't miss my next videos, don't forget to subscribe and like.